Hey, before we get started today, I want to talk about some bad actors in our industry right now that are trying to sell fear. The annuity salesman is who I'm talking about. They're using fear of the past election, fear from market volatility, fear about losing money forever. And it's all to sell you a product that pays them the most money. We have done the math on these annuities. They don't make sense, especially the indexed annuities. You need to stay away. I have a white paper we've created just for you. If you've been pitched to annuity or if you have an annuity, go to our website, wiserinvestor.com. Scroll down to the bottom. We have a buyer beware. Why do they keep trying to sell you that annuity white paper? Enter your email. You'll get emailed the white paper, and you can learn more about this vicious process that these bad actors are doing in our industry. Stay away from them. Always look for a fee-only advisor, people working in your best interest at all times, fiduciaries. That's wiserinvestor.com. Scroll to the bottom, subscribe to receive our white paper on why the annuity is a bad deal for you. Welcome to the Wiser Wealth Management Roundtable, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom as my co-host, Brad Lyons. Hey, Brad.
Hi, Casey.
And Matthews Burnett. Hey, Matthews.
How's it going?
So today, guys, I feel like I'm the adult in the room watching some very wealthy toddlers playing around. Today, we're going to talk about this GameStop Mania that's been all over the news. A lot of misinformation out there, and it's happening in the background. Also, another realization to me, how often media just gets the story wrong, and then people posting stuff on message boards also that don't understand how trading works. So I want to get to I want to get to the details and lay some things out there that are truth. But at the same time, have a little fun. I don't think any of this really affects our portfolios in the end, and certainly this is not how we think trading should work. But we have some definitions that we're going to have to work our way through before we can really start the story. So in this story, we have hedge funds. We have hedge funds short selling stock. We have a trading technique called a short squeeze, and we have a band of investors, individual investors that are coming together for a cause. So let's start at the top. Hedge fund, who wants to take that?
Well, Casey, hedge funds have been around for quite some time. This hedge fund is simply an institutional fund that is non-regulated by the Securities and Exchange Commission. It is designed for wealthy investors who meet minimum financial requirements to become an investor. And as the name implies, it's a hedge. It's designed to provide non-correlated returns to the traditional stock market.
And do you think these hedge funds are evil?
No, they're just simply another investment vehicle for people who can, afford to put money away in a long-term investment in order to correlate, again, a non-correlated return stream to their traditional portfolios.
So they're just looking for returns outside of stock market performance, and maybe they're looking to hedge when maybe the whole market goes down. They can possibly make money.
Sure. Mm-hmm. And there are lots of different strategies within hedge funds. So shorting is just one strategy that a hedge fund might employ.
But what is shorting?
Well, shorting is a way to make money in the stock market when the investor believes, after having done the research that's required, that a company is at any point in time is overvalued in the stock market and will or may decline in value over time. So it's the reverse of the traditional investing, where we buy companies that we think are going to increase in value in the future and then sell it then to realize our gains. It's selling when we believe a stock is overpriced, buying it later when it's fairly valued at a lower price, and profiting the difference.
So say that again. Let's go real slow. So I'm going to sell the stock first or borrow it.
Yeah, the mechanics behind it are a whole nother story, okay? But essentially, exactly what you were saying, you're going to borrow shares of stock that you don't own. You're going to sell them in the open market. Later, when the price decreases, you're going to buy them at a lower price, deliver the shares back to the lender, and profit the difference in your pocket.
Everyone's heads are exploding.
Yes. It is not a traditional investment strategy, without a doubt. And it's done, and it has risks. It has high risk because when we buy stock, the risk of 100% loss exists. But that's it. That's all you can lose is the amount that you invested. When shorting stock, the risk is unlimited because a stock can continue to go up and up and up and up and up, and you sold it at a lower price if it increases, but you've promised the lender that you will deliver those shares back to them. Now, if the price continues to go up and up and up and up, that person, the short seller, may be required to buy those shares at a much higher price and deliver those shares to the lender and realize a loss of money.
So they have to make sure, anyone who's shorting has to make sure they have enough collateral in the back office to cover that increase in price. Because the price goes up, you lose money indefinitely.
That's correct. Right.
So if you don't have the money to cover that, that's why they say covering your shorts. If you don't have the money to cover your shorts, they're going to say, hey, you have to liquidate this position now because you only have, $100,000 in your brokerage account. Now your short's going to cost you $100,000 if you fulfill it.
That's right. And as the price continues to go up, they may be required to continue to bring in collateral. So they may have to sell other assets in order to provide collateral in that account to offset the difference in price of that short position.
Okay. So I think we got that concept. Let's get into a short squeeze.
Now, this is something that short sellers have to be aware of in the event that as the price increases, they may be required to begin buying shares of stock. And as a group of people engage in purchasing stock, they may have the ability to push the price of the stock upwards. And as the more they buy, the more the price goes up, the larger the difference between what they sold it at originally, and now they're having to buy it back at a higher price. That continues to grow and grow and grow, and they're forced to buy faster and faster and faster, pushing the price up higher and higher and higher.
So the squeeze is like squeezing their wallets, basically.
That's the squeeze.
So if we have a lot of buyers, the price goes up, then you have to cover your short, which means you're also now a buyer of the stock, which pushes the price even higher.
That's correct. And as other momentum investors begin to see this, they jump on the bandwagon and increase their purchasing, and the price continues to go up and up and up and up.
So enter the show's protagonist, these individual investors. So where are these individual investors coming from in our GameStop store? We haven't got to GameStop yet and what they do. But so we have a message board on Reddit. It's called wallstreetbets. The slang name is WSB. I see that in tweets a lot. It's a message board. Anybody can join it. I joined it just to see what was happening. And it's just an old classic school message board. Hey guys, I'm buying this stock. I'm doing this stock. This is why I'm doing this. I'm going to do this short. I'm going to do this buy. And what's interesting is they seem to be very organized on a couple of fronts. And that when a few kind of leaders of the message board are talking, people seem to follow. These are all, there's no licensed advisors there that I can see. It's very crude comments, mix of a lot of things, which I can get into later as we tell the story. So now we have GameStop. So we have a company that sells video consoles, video games. And if you don't understand the gaming environment right now, you don't really need this store. You can go to Target, Walmart, Costco, Sam's. You can go to a lot of places, Amazon, and order these game consoles from Nintendo, Sony, Microsoft's Xbox. And when you have these new modern consoles, they just download the games into the box from the web.
Yeah, it's like a Blockbuster for video games. It's not really necessary anymore because you can download them either going to the store or just streaming it online, buying it.
So I haven't been inside a GameStop store since I was probably a teenager. I do remember them having used games.
Used consoles, used games, you can exchange there. But like you said, it's kind of antiquated process now when you could do it for a little bit cheaper and easier just online.
Maybe they should rebrand and be like a Play It Again Sports. It'd be like a Play It Again Games.
We'll see soon enough, I'm sure.
So we have a company that was trading at $8, I guess a year ago or so. Started off the year around $18. And the band of individual investors at wallstreetbets said, hey, we're going to buy this GameStop because this GameStop stock, I don't know what value they saw in the company, but what they saw was a tremendous amount of short selling. In fact, the stock was shorted 140%. That's a lot of margin. That's a lot of borrowed money, right?
Yes, because all of short selling, again, is collateralized selling. Yes.
So the stock was way overshorted, but it was overshorted by large institutions. One in particular, Melvin Capital. Melvin Capital is not a evil firm. They're not doing anything wrong. They just had shorts in some retail companies that they thought would eventually go out of business and they would make some money on, right? I have a hard time betting against things. I think that's why I have a hard time with shorting. I don't understand, like, you can be positive, win. But I guess they look at as winning as profiting on someone else's demise, I guess. It's a psychological concept I struggle with.
to get into what their thought process is, but they're simply making money off something that's the probability is going to occur no matter what. So their position in the company as a short position doesn't necessarily lead to the demise. It's just taking advantage of the demise. But whether or not they ever shorted the stock has nothing to do necessarily with the business model, the management, the product, etc.
Right. So we have a situation where these individual investors, actually led by Keith Gill, we'll talk about him in a second, say let's start buying up GameStop. There's a lot of shorts. What they're looking for is a short squeeze. They're looking.
Yeah, that's their ultimate investment strategy or their game plan. Is the short squeeze.
Now,
when force that selling, buying.
When you read the message board, the Reddit message board, there are hundreds and hundreds of comments on "I hate capitalism" and "I hate hedge funds. I hate wealthy people." Let's be really clear that the individual players, are wealthy people. These are not buying 10 shares and 2 shares and 1 share of the stock. I mean, the gentleman that owns, I don't know if he owns the most right now, but the guy who started this has a portfolio at $33 million. There's a lot of people below him at 20 million, 10 million. So let's don't think that this is the little guy trying to beat up on the wealthy hedge fund managers. He's a multimillionaire. Maybe he's not a billionaire. Maybe he's a 33 millionaire that hates billionaires. In the Wall Street Journal article that interviewed him, he said he didn't have hate for anyone. He was just looking to place bets and make some money. So, but he has a lot of followers that seem to hate the system.
It's become the little man, though, which is interesting. He might have started it, but a lot of people, like Brad mentioned, the momentum investors, a lot of people see this and they are buying small amounts of shares, and the quantity of millions of people that are buying it ends up adding up.
Those are people that probably get hurt, and that's what I'm concerned about.
In the long run.
Yeah. So we have this band, probably 1 million plus. I've read some things that seem to indicate that are buying into GameStop. The GameStop, the ticker's GME, $18.84 at the beginning of the year. The high was nearly $350 a share in a very, very short time span. What was that? Over 1,000%? I mean, that's a big number.
Yeah, that would be difficult to calculate.
So So 1885 is the beginning of the year. We push it to 350. Trading right now on a Tuesday, we're looking at 225 a share, down about 30% right now. At some point, this stock resets back to what it's actually worth, is probably somewhere between $8 and $10 a share. But there's no fundamentals behind this. You're not buying this stock because you think that GameStop is going to all of a sudden be the retailer for games, and there's going to be one on every corner, and they're going to turn around their business model.
Yeah, it's not. We said before, it's not even speculation. You're not speculating that something can happen. I mean, this is just a momentum play of investors getting behind this, short squeezing the stock, and that's why it's moving forward and significantly increased so much right now. It's not the fundamentals like you mentioned.
So the person or the firm that seemed to be most hurt by this in the news is Melvin Capital. Melvin Capital has indicated they've lost 53% of their value just in January because they were one of the biggest shorts on GameStop. Other companies as well. And it's interesting that the hedge fund Citadel and Point72 are also investors within Melvin Capital. So it's basically hedge fund investing a small portion of their funds into another hedge fund. They indicate they've lost money on the trade, but no percentage was given. Hedge funds aren't like mutual funds where you can open up a newspaper and see what's in there. You really only know what's in the hedge fund if they tell you. Even as investors, sometimes you don't even know what's in the actual fund itself.
No, they're not regulated by any regulatory agency, so they're completely free to pursue a strategy that they believe profitable for their investors at any point in time.
So we have hedge funds losing money. We have individual investors becoming multimillionaires overnight. And at some point, the music stops playing. And this stock is going to come down from $200 to $10, $8. And there's going to be people holding, and they're going to lose a lot of money. I saw an article in the Journal, Wall Street Journal, about a young man that convinced his parents to take out a mortgage on their home to buy GameStop stock, which is hopefully for their family. He got in early, and he's liquidated. At this point.
There's whole accounts now, though, that are called Hold the Line, and there's hashtags for Hold the Line. I mean, they're still pushing, regardless if it continues to drop, that they band together and they continue, even if it's not this stock, other stocks, to hold the line and continue this process for the near future. So there's a big following that's really buying into this.
What's interesting to me is their lack of risk management, because I see those same posts. I'm like, man, why wouldn't you take out $2 or $3 million to put to the side to say, okay, the rest of this can go. Maybe I get $100 million out of this, but I've got $2 or $3 million that I'm going to protect and put into other things.
Yeah, they're making fun of them for getting out and making money, and because they're not holding their position, continue to push it. It's kind of crazy.
Right. It's defying all everything to do with risk management. It's pedal to the metal, and we got a sharp term coming up, but we hope it works out.
Well, they did very little to get that money, and it has very little value to them other than its ability to get more money.
True. But when you read the message boards too, it's there's so many comments about punishing the capitalists, punishing the elite capitalists, and punishing the wealth people, saying this is class warfare. I'm like, dude, you got $33 million in your brokerage account. I don't think this is really class warfare. You're not standing in the food line. That's class warfare, right? If you can't get a leg up because the billionaire is pushing you back down, that's class warfare. Not your $33 million brokerage account. So let's sidestep for a second. You know, we're really big here with using ETFs, using index funds to build diversified portfolios, focus on the long term. There are a few ETFs, or I'm going to highlight two that were affected by this. I didn't even know this even existed. GAMR. It's a gaming ETF. So if you really love gaming, and you think this is a market you want to be in, you can buy an ETF that only buys gaming stocks. There's only 93 holdings in it. GME, the GameStop stop, was only 2.1% at the beginning of the year of this fund. It's now 27% of the fund, which in ETF land and indexing in general, that's a huge percentage. I mean, there are a few tech funds that you might go into. You might see Microsoft or Apple might be a combined 25%. And you kind of expect that because it's two very large companies. You don't expect to see GameStop being 27% of an ETF.
No, you really don't. And the ETF sponsor is caught in a midterm reconstitution of the index itself if they were to choose to take market action on this. And so given their governance structure, they're just wondering what to do about this as well at the point, probably.
If they rebalance now, it no longer is really a passive ETF. It's now an active ETF.
That's right.
Which is interesting.
Because that's been a few weeks. It's not like we're talking long-term or throughout the year. I mean, that's happened
Right.
all in the last few weeks.
The GAMR is up 53% just in the first few weeks of 2021, only because of GameStop, which is very interesting. That's something else we have to watch is what do the providers do for that. Another one is a little more common, XRT. It's a SPDR SPDR retail ETF. So if you wanted to target just retail companies inside your portfolio, you could add it. XRT is an equal weighted fund. So to explain this, basically everything in the portfolio is equally weighted. It's not weighted by market size. So for instance, Target would be the same weight as a GameStop, right? Walmart would be the same weight as Ross.
Theoretically.
So it's supposed to have a weighting of 1.5%. Well, what's interesting is that GME in this equal weighted fund is now 20% of XRT, right? That's not supposed to happen. Well, traders knew this. And so now we're going to get super technical, but you could buy 50,000 shares of an ETF and you could then redeem them. So you could go to the authorized participant, walk in. This would be maybe like a night trading, whoever clears for the ETF. You walk in and say, I've got my 50,000 shares and I want to redeem this for the underlying holdings.
Right. So, and they have to deliver back to your account all the shares of the companies that were in the ETF.
So people are hunting for GME stock so much that they're buying 50,000 shares of GME, saying, convert this, give me the individual securities instead of the ETF wrapper, right? Just to get to the GME, right? Now, these are probably not the individual investors. These are
large institutions.
Large institutions doing this, right? So because of this, 75% of the fund liquidated in one day. So it was worth $774 million, meaning that's how much assets that the company had. It then fell to $237 million in assets on one day for people hunting GME stock. That's unusual, which is very interesting.
And all they're doing, like you said, is collecting the GME stock and selling off all the other positions that were in the that have been delivered to their account from the ETF.
Which, whole different podcast, but that's a testament to exchange traded funds and their liquidity. In a crazy time like this, to be able to handle that in an ETF, and we see that with bond ETFs, times when in financial crises where the bond market has seized up, we've seen ETFs be very liquid and be able to transfer. So it's just a testament to the ETF product and why ETFs are so big now in the market versus the mutual funds. But and I will say, I'll give a shout out to ETF.com. I've worked with them on some of their conferences over the years, even all the way back to when they were Index Universe, and they had a great report on Gamer and XRT, which is where I got that information from. So moving on, we have this GME mania. Then we have something else happen. So Robinhood, where a lot of this is happening, it's a online trading firm. It's very interesting. A lot of millennials use Robinhood to trade. Most people, when they trade a stock, they would just see the value of their account, the close of the prior day, or maybe with 20-minute delay. Robinhood shows real time. So you literally sit there, look at your app, and the numbers are going up and down, up and down, up and down, up and down. Kind of negative learning for long-term investing, I would say. But needless to say, that is something that a lot of people are trading at. It's a newer platform. So in the middle of GameStop Mania, I've heard through CNBC that the average holding time was 40 seconds on the GME stock. That's how much trading was happening. So imagine all the mania. Then all of a sudden, Robinhood says, we're not trading GME anymore. We're going to stop trading GME. And immediately all the message boards light up and say, it's the hedge funds. The hedge funds are won't let us trade. And that's, there's many ways to trade. Hedge funds have the ability to say, we're not going to trade on this platform. We'll go to this platform over here, right? Individual investors typically can't move money like that. So that's an advantage to a very large institution with billions of dollars, is that, in Citadel's case, who I mentioned earlier, they actually have a whole securities firm that clears stock as a side business. They could probably even clear it themselves if they had to through with Melvin. But so GME stops trading. All these conspiracy theories go up about why it's not trading, but the answer is actually simple, but not so simple as to why it did that.
Yeah, you're right. I mean, it makes total sense that in order to trade stocks in a system like we have, there has to be sufficient trust by the investor, the trader, between firms to settle trades, because we do have a time lag between the trade date and the settlement date, which is 2 days, which means that between the 2 days, you've sold the stock, but it hasn't been delivered, and you will get the money in 2 days. You just have to trust that will occur. The trust comes from capital, having sufficient capital at each firm in order to make those trades settle. When you have such rapid trading and you have these 2-day delays, you have a current situation where you are 140% short in a stock, which means there's 40% shares that have been sold and that have been issued by the company. It's creating a circumstance where trust is leaving the system, and more capital needs to be brought into the system in order to reestablish that trust of traders.
So Robinhood doesn't settle their own trades. Most firms do not settle their own trades.
Right. They use a clearing firm.
So their clearing firm is the National Securities Clearing Corporation, which is owned by many banks, other broker-dealer firms, and financial institutions. So basically, it's an organization that clears trades, options, and stock for Robinhood. What's interesting is that we'll call them the NSCC, asked for $3 billion in additional collateral for Robinhood to help cover all the trades on their platform. So Robinhood is then forced to go out, either stop trading, or they're forced to go out and raise capital really fast. And they kind of did both. They stopped the trading of GME. They were the only exchange that I'm aware of that actually stopped trading. There was rumors of others, news reports of others, but they were inaccurate. So they stopped trading. In the end, the $3 billion bill was negotiated down to $700 million, which I would like to hire that negotiator. Maybe you can negotiate my mortgage for me. That'd be great.
Yeah, sure.
$300 billion or $3 billion down to $700 million. Then Robinhood went out and raised another $1 billion from investors, and then borrowed $500 million on their own. So they raised additional capital. Now, still, my understanding is, as of today, GME is still only trading one share and one option, or 5 options and 1 share, I think.
Simple options, not complex ones.
Yeah, and that's what TD Ameritrade did. TD Ameritrade did not stop trading of GME. TD Ameritrade stopped the complex options, and that's just because they're trying to protect the investor, I think, in the end, because that could get away from you very quickly.
Something we hadn't talked about, though, is the reason that a lot of this can happen is because of zero commission trading. Not too long ago, it would have been significant per trade. And then even a few years ago, it was a big deal that $5 commissions, that was so significant. Now we have $0 commissions. So that allows these people to trade within the minute and not have to pay those commission fees, which can be significant when you're doing that type of day trading.
Yeah, absolutely. Yeah, I think there's some thought that has to go into that. I saw an interview with one of the former TD Ameritrade CEOs on CNBC I guess it was yesterday morning, and he was stating that commission-free trades is good for everybody, but we have to make sure our firms are properly capitalized. So probably a little agenda on his part, trying to beat up on Robinhood a little bit in his comments, but. We even had politicians weigh in. AOC and Ted Cruz said, man, if you stop trading...
Those are strange bedfellows.
That's right. It's like, if we, not allowing people to trade is not responsible, and we should have a hearing on this. And honestly, I don't think AOC and Cruz are smart enough to understand everything we just explained to you guys on our podcast. So that'd be a very interesting hearing if that indeed happened. But basically, there was no hedge fund calling up Robinhood saying, "Hey, we're going to stop. You need to stop trading. We're hurting here." That did not happen.
Makes for good news though, and to click the article.
Yeah, it makes for great news. That sitting out there is just false. There's some other stocks too. AMC, Bed Bath & Beyond, Koss, the headphones. We were just discussing before we started the show today. What has anybody even seen Koss headphones? I don't know that we have. Maybe somebody can explain that to us. The guy behind it, Keith Gill, pretty good interview in the Wall Street Journal as well. Basically, he's 34 years old, has a 2-year-old daughter. He's amazed that the story has gotten so much bigger than him, but he has a portfolio now. He has a snapshot of it. He has a YouTube channel, of course. $33 million is what his GameStop stock is right now, including options and millions in cash. Former employee of Mass Mutual. He was not an advisor there. He was, I think, in media or IT or something of that nature, support basically. So anyway, good for him. One of the hashtags is GME YOLO, YOLO. You only live once. So
I saw there's a YOLO index now. I'm not sure exactly what it is incorporated in that, but there is a YOLO index that people have created.
So basically, buy stock because it sounds like it could be great, but there's no fundamentals in it, and hope for the best. I feel like YOLO is more like should be applied to trips. Like
vacations.
Let's go to Europe or let's go to somewhere you only live once. But I never really thought that with the stock necessarily. If you want some entertainment, we should do a whole podcast on this, guys. Hashtag TikTok investors, TikTok investors. Matthews brought this to my attention over lunch a few weeks ago. You'll find some very entertaining tweets.
Do not follow any of their advice.
Do not follow any of their advice.
Good disclaimer.
Yeah.
One of my favorite ones is a guy on there, and he's like, I bought the stock and it went up, and then it went down, and then I sold it, but then it went back up, and I bought it again, and then it went down, and so I sold it, and then oh my gosh. I was just sitting there laughing going, this is horrible.
What's funny though is that it was 2 weeks ago. Y'all remember Bitcoin? That's all that everybody talked about was Bitcoin. Now it's just a thing of the past right now, and everybody's talking about GME and AMC and the mania going on right now. It has nothing to do with the Bitcoin.
Bitcoin 43,000 near the high. Now we're down like what 30? We at 32, 33.
It's dropped significantly. It's still higher, but yeah, that's not the new rage right now. Everybody's buying these undervalued companies.
That's our next podcast, by the way. Bitcoin. We're going to bring it back. Wall Street Bets is going to be talking about the Wiser Roundtable and the Bitcoin podcast coming up. All right, we got to wrap this up. This is getting long, guys. How long do manias run? I mean, one of my favorite books, Random Walk Down Wall Street. You should read it if you want to learn about investing and be the adult in the room instead of the children. But one of the first chapters, I believe, is talks about stock manias, and one of the first ones recorded was Tulip Mania in Holland. So when you say mania, I always default to Tulip Mania, but I don't know the answer to that. They run until they don't. And when they don't, people are left destitute. So you got to be careful out there.
Yes, you do. It's like the musical chairs. You don't want to be left standing when the music stops.
That gives me anxiety just for these people. I don't even know them who are playing in this. But there's a lot of millionaires made in the last few days for sure, and there's going to be a lot of millionaires that are going to talk about how they used to have millions of dollars for a few weeks. So anyway, focus long term, keep your costs low, and then maintain a diversified portfolio that's never letting anybody down.
We expect it won't.
All right, have a great week. We'll see you guys on the next podcast.
Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.